How's everyone doing today? I'm John Forster, the Professional Development Edge podcast. I'm happy to be here today to talk about building blocks of IFRS 17. And we got a really awesome guest here today. We got a principal from Deloitte Consulting, industry leader. He's a former SOA board member and currently a member of the Professional Development Curriculum and Content Creation Council. We got Darryl Wagner here. How you doing today, Darryl?
I'm doing well. Thanks, John. It's great to be with you.
Excellent. Great to have you. And for those of you who don't know, Professional Development Edge Plus is the new subscription service offered by the Society of Actuaries. Check it out on SOA.org. With the subscription, you get access to all of the SOA's live webcasts, 70 to 100 webcasts a year. You get on-demand content with webcasts and meeting recordings. You got some really engaging short-form video content that are 5 to 15 minutes long, a good time frame, and gets a lot of valid information out in that period of time, as well as you get some great courses with learning objectives and knowledge check questions. So definitely check that out. This will be on here as well as out on our platforms. So Darryl, let's get into it. And first, I want to see if you could tell me a little bit more about your background. You've been a long time in the industry, so why don't you tell us a little bit about that?
Sure. Thanks, John. And hi, everybody. As John mentioned, I'm a principal at Deloitte. I've been at Deloitte 23 years, almost 23 years. And as I look at my whole career journey, really from my very first rotation, I started an insurance company. I've worked with valuation and financial reporting of insurance and annuity business, and have really enjoyed that and being able to go in a lot of different directions with that professionally as I've moved into consulting and had the opportunity to play some leadership roles at Deloitte, including globally, which I really enjoy. I would also add that IFRS 17, the topic we're talking about here, overlaps well with my background. And IFRS 17 is a standard that was 20 plus years in the making for reasons that I'm sure we'll talk about. So it's overlapped quite a bit with my own career. And I appreciate the call out on volunteer work, John. I'm a passionate SOA volunteer involved in areas ranging from education to research, governance, and international, and even delving into the musical realm at times.
Yeah, I can't have you on without asking you about the Regulators. I'm a fan of the band. I've seen them play. Why don't you talk a little bit about that? Kind of combines your passion between music and actuarial.
IFRS 17 and music, two of my favorite topics, and we get to talk about both. I appreciate that. Yeah, the Regulators is an actuarial band that we first put together for the annual meeting back in 2009, and we've been back once since then. But it's been great fun getting to know a group of actuaries making music together and being able to share that with a broader audience at the SOA meetings. Just love it. And I hope that we will be returning to an impact meeting stage near you, so stay tuned.
Yeah, so I seen the Regulators. I also seen you do karaoke. Great musical talent over there. So let's get the quick overview of IFRS 17. Why don't you give us that to kick it off?
Sure thing. And I'll step back a bit. I'd just like to set the stage in terms of insurance accounting. Insurance accounting, among all different industries of accounting, is extremely challenging for a couple of reasons. One, you're dealing with a product which is intangible, and the inventory of that product, therefore, is also intangible. Second, you're dealing with a product that can take decades, many decades in some cases, to ultimately deliver to the customer and to determine what the true cost of that product has been. So those are precisely the reasons why actuaries play such an important role in insurance accounting. It also means, though, that there's a number of judgments and assumptions that need to be made in insurance accounting. And for those reasons, we've seen over time around the world many different ways of doing insurance accounting develop, different frameworks in different countries and regions around the world. Some of them a little focusing on more conservative estimates than others, some perhaps focusing more on the balance sheet versus the income statement. Others might be just looking at things from a different point of view. So IFRS 17 was conceived to really help bridge those differences around the world and develop an accounting model for insurance that could be used and adopted around the world. And that's why it took so long to develop. And I would call it a principles-based standard, one that's focused on the balance sheet, but also tries to very much stay true to accounting principles across all industries, and moves in the direction of current and best estimate of insurance liabilities, with a goal of providing not only more consistency of reporting around the world, but also more transparency in that reporting.
Excellent. And let's get into some of the challenges that the actuaries are facing with IFRS 17.
Yeah, IFRS 17 was certainly a big lift for the companies that had to implement it. It brings with the challenges of any actuarial process in terms of understanding the requirements, of developing the assumptions needed, and ultimately producing the results. A couple things I would call out, though: the data requirements are significant because it is such a different standard in many respects. It meant looking for new data sources at a more granular level, and that it can be a big challenge, and can involve work from a lot of teams, as well as technology revamping. In addition to that, the technology to actually produce the numbers in many cases meant upgrades to existing systems, or companies needing to bring in or wanting to bring in new platforms, from actuarial modeling to subledgers, ledgers, and everything in between and related to that. Many companies did see and leverage IFRS 17 as an opportunity to modernize or upgrade their processes, but that is a big lift. And then finally, the selection of the assumptions, the production of the results, and interpreting and communicating those results to others was extremely challenging. I'd mention one other thing, John, which is IFRS 17 is truly a team sport. Actuaries working closely with their technology colleagues, with accounting colleagues, and I think it's helped us forge better relationships and some new working models of that cross-discipline working together, which I really think is going to be valuable as we move to the future. And I've got to give a call out to the actuarial profession, who stepped up big all the way from the long incubation period of IFRS 17 into helping companies implement it.
Yeah, excellent. And I do agree that cross collaboration is key to a lot of these processes, especially the complicated ones such as IFRS 17. So let's get into how actuaries determine the best estimate liabilities, and what factors do they consider in this calculation.
I'll use the term building blocks, John, which is frequently used to describe IFRS 17. IFRS 17, it's an insurance accounting standard, but most of it is devoted to describing how you value the liability for an insurance contract, which of course is very familiar territory for actuaries. And you can think of that manual for building those liabilities as prescribing a few building blocks, the first of which is best estimate cash flows. And those cash flows, at a high level, are produced the way actuaries would produce other cash flows: comprehensive projections of premiums, benefits, and claims, as well as expenses. In the case of expenses, there's requirements about how to determine whether expenses are attributable to the business being valued. There's a concept of contract boundary that essentially puts the horizon or limit on the period of time over which you're projecting those cash flows. The assumptions used are to be best estimate, and those are best estimates from the point of view of the company. So the entity's own view of those cash flows based on their own experience and their own view of the future. The term fulfillment cash flows is sometimes used to describe that. And then finally, IFRS 17 calls for not just a single best estimate of cash flows of a scenario, but really a projection that considers and encompasses all the possible probable outcomes of cash flows. So that really requires actuaries to think about the optionality, if you will, in products. And it doesn't necessarily mean a stochastic projection needs to be used, but in some cases that would be required.
Got it. Yeah, sounds good. And let's get into risk adjustment, and what methodologies are used to assure we're meeting the requirements in the risk adjustment side.
Sure thing. After coming up with the cash flows and discounting those to get a best estimate liability, the next building block in the progression is the risk adjustment, which is an explicit provision for risk. And this does differentiate IFRS 17 from many other accounting bases. The guidance in IFRS 17 around risk adjustment is principles based and pretty simple. It says that the insurer should be establishing a provision that would represent the compensation they would want to receive for the uncertainty in the cash flows. In other words, to make them whole, if you will, for the uncertainty, the risk that they're taking on. From that guidance, then insurers and actuaries are to develop the risk adjustment. The standard does not specify a methodology. It does give several characteristics that methodology should satisfy. And in practice, we see a range: cost of capital approaches, more statistical approaches, methods like variance or conditional tail expectation, which gives insurers the ability to leverage some of their existing methodologies in cases. There are some disclosure requirements, though, that help harmonize that, as all risk adjustments are to be referenced in some way to a variance type estimate.
Excellent. And CSM, that's a big acronym in this world, contractual service margin, under IFRS 17. Let's talk about that and some of its key components.
Yeah, sure thing. And the CSM, or contractual service margin, perhaps the most unique part of IFRS 17, although for those of you who are US GAAP folks and speak US GAAP, you can think of it as a deferred profit liability. Really the final building block in the progression to a liability. The contractual service margin represents any remaining profitability after providing for the best estimate cash flows and the risk adjustment. That balance is then amortized or taken into income over the life of the contract up to that contract boundary, and done so on a basis which is consistent with the way that product is delivered to the customer over time. There is some important granularity to the CSM. It should represent no more than 1 year of business as you're determining CSM for different groupies and policies. But in addition to that, there are groupings that are prescribed by level of profitability. So companies are to look at contracts which are onerous, meaning not profitable or loss-making, and separate CSM out for those contracts. Secondly, to look at contracts that are profitable with no significant probability of becoming onerous, separate CSM for that. And finally, any contracts that don't fit into any of those other two categories. And companies are encouraged to make other splits as they feel necessary. So that is part of the challenge, part of the difficulty in implementing IFRS 17 is getting to all those levels of granularity. I do think, though, it presents some opportunities for companies to better understand their business, and in some cases might even affect how companies think about managing their portfolio and dealing with different blocks of business based on those characteristics.
Excellent. And let's talk about the comparisons between other bases in accounting. So you have US GAAP, for instance. Why don't you tell us a little bit about how IFRS 17 compares to these other insurance accounting bases?
Great question, John, and an interesting one, because since IFRS 17 is being implemented around the world, that question of how different is it depends on where you are in the world, because I think it's over 100 jurisdictions that are implementing IFRS 17, the change is really from your existing or prior basis to IFRS 17. So that's part of the complexity around the world, is your different starting points, the same ending point. As I said, IFRS 17 is a principles-based standard. It's establishing best estimate, current estimate liabilities. And that is different than a lot of jurisdictions. One thing I would mention is, in US GAAP is a good one to focus on here. There are a couple of notable exceptions to jurisdictions or countries around the world that adopt IFRS 17, and one is the United States. The US did not choose IFRS 17 as their official insurance accounting framework, and instead has made changes to US GAAP, known as long duration targeted improvements, which I know PD Edge Plus has some great content on as well. In the case of US GAAP, if you look at US GAAP prior to LDTI, the directional movement towards IFRS 17 versus LDTI is in a similar direction, but I would say IFRS 17 goes a little further in some respects. Both IFRS 17 and LDTI look for best estimate liabilities. There are differences in the way you deal with expenses. LDTI and US GAAP before LDTI include an explicit DAC, or deferred acquisition costs asset that accounts for those. And then there's also differences around the way changes in experience are reflected. Both standards require the updating of liabilities for changes in experience and changes in assumptions. But the way that's done, the mechanism of that is different between the standards. And depending on the type of change and whether that change affects the current period or future periods, it can have different effects between the two in terms of profitability. So long answer short, there's a fair amount of commonality between US GAAP and IFRS 17, but some important differences that add not only to that complexity, but also mean you could get some pretty different answers for the same product under different bases. And those same kind of differences could apply in different parts of the world as well.
Yeah, excellent, Daryl. And we're going to end it on this last question. What are some best practices for actuaries to assure compliance with IFRS 17?
Yeah, compliance is key. Again, brand new standard, one that brings a fair amount of complexity and change. So making sure we get it right at the start and that get it right on a continuing basis is really critical. And just as with the rest of the topics we've talked about, actuaries play a key role in that, working closely with their accounting and finance colleagues. A couple things I would say. One is making sure that the methodologies, the approaches are consistent with the standard is something that we've just got to be ever vigilant on. That's one that had a heavier lift, most likely at the transition or the implementation of IFRS 17, but certainly needs to be a continuing process, particularly as changes arise in products and experience and so forth. And then making sure that the data feeds, the technology calculations, the movements from actuarial systems to ledgers and subledgers is accurate is critical. And certainly you'd expect to see a mix of some automated controls, but also a fair amount of judgmental review and analysis, as well as some recomputations and other manual controls that would come into play. And those are not new ideas or new types of approaches, but they've certainly needed to be refreshed and updated for the IFRS 17 framework. And then finally, I would say as it gets to producing the results, from an actuarial point of view, taking a good look at those results in aggregate at more granular levels, looking at the trends and movements, and really the ultimate test being, can I explain those in a reasonable way? Can I tell that story? Does that story make sense? And in cases where the story is not making sense, that's a good signal to dig deeper and perhaps go back to some of the other approaches. So really an ongoing journey, but again, a great call out to the actuarial profession, who I think has stepped up big time on this and been a big part of making sure that we get this right.
Yeah, definitely. This has been an enlightening conversation, Daryl. Very, very great. I know I'll be talking to you soon. Thanks for everyone for joining in, and check out Professional Development Edge Plus. We'll be catching up with you on future podcasts.
Thanks, John.
The views and opinions expressed in Society of Actuaries podcasts are those of the speakers or authors and do not necessarily reflect the views of their employers or the SOA. The opinions expressed should not be construed as legal or professional advice and are provided for educational purposes only. Please see the terms of use on SOA.org for more information.